Good afternoon and welcome to the Dairy Signal. We are back with Ben Buckner, Chief Grains and Dairy Analyst with Ag Resource Company for another market update. Just a quick reminder before we get started that this is a live program, so if you do want to ask a question, go ahead and click those three dots on the bottom right corner of your screen and click on Ask a Question. And as always, the continuing education credit quiz will be at the end of the program. So with that, Ben, we're glad to have you back and take it away.
Okay, well, thank you so much. And as always, a pleasure to be here. And we will jump right in. In the last 2 weeks, not a whole lot has changed. I think fundamentally, the drivers of price, same as they were. There's no shortage of milk, expansion, ongoing, kind of accelerating on the margin in some places. And I don't think there's going to be a shortage of milk, at least through the balance of summer. So the markets are contending with that and kind of sagging on a global basis. Feed costs are also low, and the perception, which makes sense, is that feed supplies will be abundant in North America and probably globally. When we think about, July 1st, August 1st, ag markets are efficient, but also a little bit myopic and short-sighted, and so that's what the focus has been. We'll kind of talk about U.S. weather, short-term and long-term. It does look pretty good. I think, though, to start off, though, we want to communicate very almost strongly that margin management is, I think, the game of 26, 27. And I know margins have deflated a little bit from the peaks of recent years, but we still like what we see, and we do like taking action in the feed markets, kind of where current prices are, or thinking about using the next 2 weeks, maybe 4 weeks, to start positioning long in the feed sector. And part of that is just because corn is not expensive. And even thinking about end user margins, where US corn sits in the global marketplace, it's very competitive. And there's a lot of incentive to use as much of this stuff as possible. So I think that's kind of the starting point is corn is not expensive. From some measures, it is cheap. And so let's make a move, the appropriate move there. I think what's kind of changed in the last 2 weeks is the memorandum of understanding, which has been signed. And so if it holds, it does give us 60 days in which the Strait of Hormuz is opened as the US and Iran continue negotiations. Nothing permanent has been finalized, and we will have to deal with headline risk intermittently, I think, over the next couple of months. But the market has said there's crude oil to be flowing and shipped out of the Middle East. Crude oil stuck on vessels until now is finding homes. And I think that this will incentivize a lot of production pretty much globally. And so the sort of accordion that is US and world energy markets is starting to expand instead of contract. And so the market thinking about forward risks, $75 crude oil makes pretty good sense to us from a fundamental standpoint. There is not a lot of energy, whether it's crude or distillate products in the US currently. And in fact, when we think about total US crude inventories, the current level is the lowest since 1984. But I think the market, we know how these things operate, is thinking about the next 60 days, maybe 90 days and beyond, and things getting closer to normalcy. So this is helpful for fuel cost, input cost, but it's also kind of had this knock-on effect of any war premium that did exist in energy markets and agricultural markets as well is being unwound. And thinking about corn, soybean oil specifically, and the way margins did look, 30, 45 days ago. Ethanol prices in the Midwest swap market, up to $2 per gallon now are $1.80 per gallon. So I think that's been the fundamental catalyst for weaker markets like soybeans, corn, and soybean oil. But this, hopefully, the worst of supply constraints in energy markets is behind us, and that has been kind of a driving factor of price discovery across the board for the last couple of weeks. And to that end, class three milk has struggled, and dairy markets in general have struggled for really the last month or so. And I think it's the myriad reasons why. I think whatever war premium did exist is being unwound. Can't identify a production threat yet, though we'll talk about something that may be blooming in Western Europe. But also, as crude oil has been expensive, and even as crude oil has fallen, $20 to $30 per barrel, we're looking at things like consumer sentiment, restaurant traffic, and in the background, since the very end of winter, we are, can slowly begin to quantify this. Just the markets are really struggling to find domestic demand growth in particular. And that's been the case really for the last 4 years. But when you think about milk output expansion in the US colliding with really stagnant domestic consumption, at least, it just allows inventories to build and there is no urgency on behalf of the end user or the consumer to chase rallies or to pay up for protein and fat. So class three milk, July, August, September, really across the forward curve has been eroding, kind of renewed bear trends this week. And so we've had to adjust our summer cash price forecast lower, but just a little bit. There's still, even today, pretty substantial premiums in cash prices. And I think for now, or at least for the next couple of months, we'll still be rooted in very, very lofty non-fat dry prices and whey. And the whey market, I think, has found equilibrium at about 65, 70 cents per pound, and that is being smoothed out. So we're not seeing the volatility in the whey market that we've seen the last 18 months, but I don't think there is fuel for either higher whey prices, but certainly not lower whey prices when we think about demand that exists today for protein, high protein concentrates, especially. We can't seem to make enough of that stuff on a monthly basis. So I don't think the whey price in the cash markets changes, and that's going to keep these premiums in the all milk cash price relative to class three. So anyway, we're thinking about 19 to 19.80, maybe $20 all milk cash prices through the balance of summer. Has been higher, of course, but all things considered, given cheap feed, falling energy prices, I think that we can make this work. It's just a matter of wanting to make it work and kind of locking in these margins in the next, again, 2 to 4 weeks. I think the next catalyst for changes in income over feed or milk feed price ratios will be the USDA's stocks and seedings reports, which are published on June 30th. And it can be the case, and it has been the case, that these quarterly stocks reports the last couple of years have really lacked surprises. The market, I think, coincidentally and luckily, has been able to kind of track disappearance, estimate stocks pretty accurately. So there have been no surprises. But I will say, as being an analyst now for 18 years, to get precise acreage updates and quarterly stocks, which is a function of residual demand, not a category, nearly impossible. So there can be surprises in this. And we have seen in the past when there are early seasonal lows in markets like corn, wheat, and soybeans, those tend to be triggered by surprises in those stocks and seedings reports. So I do think we've got 2 weeks where the markets probably do very little on the feed side. But then again, thinking about just starting to position yourself for kind of post-summer rallies and feed costs, I think makes sense. And so this is kind of still where we are, and we will revisit this very quickly, but we kind of added another month to exporter world in European milk production. They're the last of the major exporters to report April output, and as expected, wasn't much different from really the rest of the world or the last several months. Now, we are beginning to compare 2026 to very large production levels in 2025, and so on the margin, these changes in percentages will start to drop, but we're still producing an incredible amount of milk, and we're making an incredible amount of dairy products and putting those into exportable positions. And so that's important. That's a big driver of price to us. But European Union plus UK production in the month of April, for the 13th consecutive month grew. It's 14.8 million tons, up about 2.3%. So we kind of put together the entire exporting picture, and it was up for a 21st in the consecutive month, up year over year. And since January, the exporters, U.S., Europe, Oceania, have produced 102 million tons, up about 3.5% from last year. So 8 billion additional pounds of milk have been produced in exporting markets in the first 4 months of the calendar year. And so again, we kind of think about this from a very high level. If these bars on these graphics, you keep it very simple, are below zero, you tend to be in a tightening market, a bull market in the Chicago class 3 space. If they are above zero and meaningfully above zero, kind of the opposite happens. We're in an adequately supplied to oversupplied market. And that's still where we sit today, and probably where we sit for, again, the rest of summer. And I think barring either major widespread weather adversity or some kind of geopolitical shock, probably through the rest of calendar year 2026. So part of our price outlook risk management strategy does not hinge upon world milk supply disruptions. And even in the US, just as we think maybe the beef cow supply, beef price issue is starting to be solved, the opposite happens. And I think because screwworm has made it across the Mexican-US border, it doesn't impact beef consumption to us or consumer sentiment, but it is going to challenge herd growth that was already challenged to begin with. We're also on the margin, at least. I know this is not a large beef or production region of anything, but you think about the Rocky Mountains in West, having little to no rainfall, maybe throughout the rest of summer. So when you think about the national cow herd in the beef space, I don't think there's a lot of evidence to support it growing in the next 6 months. And maybe we go another year where the cycle has been extended, 2 years beyond what it normally is. But I think because of that, we kind of identify maybe like the cash wave market. There may be limited upside in beef and beef cows, but certainly limited downside. I think you've got a lot of incentive to sustain beef dairy cross production. And so that's been, I think, the catalyst for very large and aging cow numbers. But I don't think when we think about USDA milk production reports for the next several months, they're going to be meaningfully different from the last 12 months. And so we kind of assume something like normal, modest downtrends in cow numbers, but nothing considerable or threatening. So we still think the cow herd is going to be at least 9.6 million head into the end of June. I'm assuming the average per cow growth, and we're still looking at all-time record productions for the next 2 months and probably for the next 6 months. So we think that we're going to produce something like 20.5 billion pounds of milk in the U.S. in the month of May when that number is out next week. And most likely in June, even being conservative, something like 19.6 billion pounds. That's up about 2% year over year. So again, it's just very quickly revisiting milk supply and demand. It's hard to identify, one, of course, the threat to milk supplies today, but we just can't really see it developing in the next quarter or so. So that's what the markets are contending with, shedding risk premium because there's going to be a lot of stuff available. This is what the USDA gave us, last week, and none of this was terribly surprising. Even the USDA and all their wisdom kind of look at the CME for guidance when we think about forward cash price forecast. So they trimmed the all milk cash price forecast about 55 cents per pound to 2070, still historically a pretty decent price, and lowered class 3 40 cents to 1660. And I think the summary of the USDA's June was it was really a loosening of supply and demand. And I think that's important and probably, in as much as USDA WASDE reports matter to the milk markets. It's kind of the opposite of what we saw the previous 2 months, where the U.S. dairy balance sheet in 2026 was never tight, but we were kind of seeing export demand growth legitimately outpaced production growth, and so we were finding homes for all this milk that we were producing, and there wasn't really the risk of oversupply or ballooning inventories of anything. That's kind of changed, and that's I think when you get into the weeds, it really comes down to really no herd liquidation, and for whatever reason, national per cow output has been revised upwards the last couple of months, and it's been generally better than expected. So this is just at some point, especially when you get to the midpoint of the calendar year, just arithmetic. So the USDA, probably rightly so, raised 2026 annual milk production in the US, a full billion pounds to 236.4 billion. That's up almost 5 billion from last year, or 2%. And 2% growth annually, kind of at the upper end of history when we think about the last 2 decades. So we're kind of repeating what happened last year, where we can all see and feel, we know US milk production is expanding. Processors have no shortage of access to supply. But now when you kind of cross this threshold where growth isn't 1%, it's 2%, there's just going to be a lot of milk coming at the market, especially even in the next couple of weeks. We're still kind of in the throes of peak northern hemisphere milk output as you transition into summer. There are more days in the month in May, and so when we think about like Europe, Russia, Canada, United States, this is when we have the most milk available of the calendar year. It's probably about this week or last week, maybe the week before. So anyway, supplies tends to dominate, especially when you do have kind of these intermittent recoveries in class 3. But this is what jumped out to me, and I think this does make sense, and we'll kind of segue into, I think, one of the it's not alarming, but to us, the most concerning thing when we think about, milk price risk management between now and April 2027. And to be very upfront, we do like hedging Q1 27 output, if not at the market today, then on 20 or 30 cent recoveries. which again, not a lot of insight. Q1's very bad for milk pricing and per day consumption of dairy products, but I don't think the market's really pricing a lot of that in when it's at $17.50, basis Jan, Feb, March futures. But this is what jumped out to me. So we raised production calendar year 2026 1 billion pounds. Fat-based milk exports will be pretty special at 20.6 billion pounds. That's an all-time record by a pretty wide margin, but it's up only 300 million pounds from USDA's previous forecast in May. So you have this discrepancy between production growth and demand growth getting wider, not getting smaller. And I think when you think about not only exports, but domestic use, it's been shown to be a challenge to grow disappearance of dairy products. And part of that is because already, even looking at last year's, summer demand was very, very high, the highest it's ever been. Exports currently are the highest they've ever been. So growth is going to be challenged, decreasing marginal returns, et cetera. Milk production, probably not. I think they are correct in their forecast for up 5 billion pounds from last year. So again, thinking about this as some kind of accordion, it's getting, it's expanding, it's not contracting. So I think we've got to contend with just a lot of milk. We've got to process it pretty quick. We got to sell it. We got to find a consumer for it. And just thinking big picture, what that means is, without getting precise price targets, U.S. dairy's got to be competitive globally. So all that says it's got to be a penny cheaper than anywhere else in the world. And we got to find prices or sustain prices that do keep the U.S. consumer domestically pretty active in buying stuff. So none of that's foreshadowing some kind of bullish run, at least through the remainder of summer. And I think exports, their forecast is correct. It's been very, very good and kind of good despite increased competition, from places like New Zealand, even European cheese. Something we've talked about the last several dairy signals is, for the first time in about 18 months, European cheddar is priced at to maybe fractionally below the US market. It hasn't really had an impact on physical disappearance yet, and really didn't 8 and 10 weeks ago either. So the global consumer, the importer, Canada, Mexico especially, are going to continue to buy US cheese and US dairy products. Even parts of the Middle East still buying US cheddar instead of European cheddar. So that's promising. So this looks good. I don't think there was much of an issue with the U.S.'s share of world dairy trade. This is a positive. We are finding a home for this really large milk production in the export sector. It's a domestic consumption that I think, again, is probably the most concerning thing to me. When we think about what is the value of milk, what is upside potential, where do we need to strategize in terms of managing price risk? And again, it's Q1 2027. And I think this is one of the reasons why is there can be at times production issues. Maybe there's not the incentive to sustain large dairy cow herds, or something happens in Europe, weather, which we'll touch on, or Oceania because of El Nino. Part of the buffer against all of that is just a lack of domestic dairy consumption growth. Again, what you see here has really been the case for the last 3 full years, but it is ongoing. And so the USDA, and this is to keep the market balanced, I think, rather than kind of forecasting what it actually will be. It's got to be about 223, we think maybe 223.5 billion pounds. We've got to make disappear in the fat-based domestic market. And so kind of at the upper end of recent years, doesn't take a lot of growth, but it's a pretty large number. At the same time, what we can do very slowly is kind of work into what is actually being made to disappear, at least as of currently the end of April. And so we got, you build this puzzle over the course of several weeks to get production data, get export data, imports, and stocks. And finally, you put that all together and you know what was disappearance. So we'll call it demand, but just this cheese did not exist any longer during this month. And so what we started to see in the month of March after very good first 2 months of the year was slowing cheese disappearance, stagnant butter disappearance. So whatever is happening, we know that cheese consumption was down about 7 million pounds year over year in March and down about 10 million pounds year over year in April. We still have peak seasonal cheese demand coming at us. It is in front of us, not behind us. But I think this just kind of validates the struggles that the market's having, whether it's restaurant traffic, high energy costs, or just we've kind of reached a demand level that's going to be hard to exceed unless we've got population growth above and beyond what it currently is in the US, North America, somewhere on Earth. So that's kind of a long-term generational issue. When we kind of back into when we think about the fat-based milk market, what's been made to disappear the first 4 months of the year, and it's 71.1 billion pounds, up about 0.8%. So this and the USDA's forecast are aligned, but the thing that we want to watch is will cheese consumption specifically be able to grow in May, June, and July when peak demand does hit the market. If not, then I think the market's got to do more to balance supply and demand. And so equilibrium exists today, but we are concerned that that equilibrium price does kind of inch lower and lower as you get into the winter months, 26, 27. Something else that, again, thinking about risk management, selling recoveries, putting your margins in order for the next 6 or 8 or 12 months. The global dairy markets, more so than last year, really have been kind of reacting to this building supply of milk in Argentina, Europe, New Zealand, Australia, Europe, and the US to some extent. So every 2 weeks we have a global dairy auction, kind of weighted towards the Oceania market, but it's been sagging for the last 6 weeks. And so kind of every new auction we get, we've got butter, cheese, the average weighted average price of all dairy traded at these auctions down a few pennies per pound. And that's been a trend that's been in place again since about the end of winter. And so you can kind of see when we get too expensive, the consumer shuts off, we produce a lot of milk, and this is where we are. I don't think the world cheese price moves, but this is pretty clear that you telling us the US market can't move much above $1.80 per pound, or else we lose that much needed demand growth that market requires to balance supply and demand. So we do have, generally speaking, very, very solid demand for protein and fat globally, the whey market especially. We've got a lot of production, though, no sign of supply disruptions. And so I think this kind of explains the forward curve in the class 3 milk market. It's been somewhat dull relative to the last 5 years since the early part of 2026. And you kind of see everything's kind of clustered together between $16 and $17 a hundredweight. I think that makes a lot of sense. Again, like a lot of these markets, I don't think there's the fuel to sustain significant up or down trends for the next 60 days, let's call it. But I do think that when we look at the low end of this range, those typically occur in the winter months. We can't rule out the risk, even if equilibrium is found between supply and demand, that drops to something like $15 a hundredweight in January and February. So I don't think that's even too much of a bold call to make. So kind of like we recommend using the next 2, 4, 6 weeks to just generally position long in the feed space. Kind of the opposite holds in milk, where we want to use recoveries, even seasonal trends, peak dairy demand this summer to kind of position yourself, hedge yourself for downside milk price risk. At the same time, this is where we are today. And so again, this is why we want to think about margins, income over feed costs being pretty good today. But does this get away from us when we think about the next 6, 8, or 12 months? And so far, the corn, soybean meal, soybeans, and wheat markets have really been unremarkable from a seasonal perspective. But again, to be very clear, we like locking in margins close to where they exist today. They are not bad. Corn is broken pretty hard over the last 10 days. And I think this is where we kind of start the process of talking about that there being value in corn and protein meal at current prices. And so it is not unique for the corn market to break, and often break pretty hard after April 15th, or certainly after the last part of May. And that happened this year. I think what we are thinking about is what do you do with the market now is the speed and intensity of Chicago corn's break, though. We kind of accomplish what we normally accomplish market-wise in something like 3 months in a matter of 8 or 10 days. And so if thinking about this chart, so we just kind of plot the seasonal evolution of Chicago corn, again, you can see it's been pretty unremarkable, done what it usually does. This break has been very swift, very intense. If the trend over the next, let's call it 3 months, follows the normal trend exactly, this will give us some kind of guidance at least. You have lows probably in the first half of August at about $4 per bushel. There was, to get into chart patterns, an open chart gap at $4.05 per bushel. That almost got filled this week, didn't quite. I suspect it will be filled. But at $4 spot Chicago corn, you kind of accomplished a lot of the goals. And so I guess to put it simply, we had downside targets of $4. We got there in a week. And so we still think that that is kind of uh, closer to lows than anything else, and there is a lot of value in $4 corn. And even thinking about the last, decade, the last 10 years, just wanted to highlight this is where corn prices sit this afternoon relative to the last 10 years. It's not an expensive price. So I think when you kind of measure what is the price risk, what will the directional moves be for the rest of summer? And I think even if weather is very good, downside risk is present, but is it kind of capped at 10, 15 cents per pound? The market is broken 80 cents per pound. So just thinking about probabilities, I guess that would kind of put you in sort of a bullish camp if you had to pick between the two, being bullish or bearish. So again, thinking about scaling into purchases, we think makes very good sense on the way down anyway, but 5-10 cent corrections in corn, cash markets, futures markets, start positioning ourselves for post summer, which if we go back, following even just normal seasonal trends, or I think best case scenario, if weather is very good, you kind of repeat what happened the last 2 years. So this slow evolution, but you're talking about lows at $4 at some point in the summer of 2026, highs like this year, $5.20, between February and April. So it's pretty uncomplicated, the strategy in corn every year, but this year might be exacerbated by what we think is Chinese demand that's forthcoming, record global corn demand, and we are still struggling to kind of explain why demand for corn globally has exploded in the last 18 months. We can kind of see and feel, and we know through even press releases that Brazil's ethanol industry is expanding very rapidly. So we can quantify, account for that, but this goes above and beyond that. Importers just securing incredible amounts of corn. U.S. corn exports maybe something like 3.4 billion bushels this year, and 3.5 billion bushels next year, and that's not even a very dramatic forecast. I think that's just kind of goes along with the trend in world trade. But more reasons I think that there's value in corn today. And this is chart pattern, relative strength index, the measure that tells you whether the market is overbought or oversold. Corn today is oversold. And that's okay. That doesn't explain any given week's price action, or the market doesn't have to do anything today or Monday. But notice that this is always reconciled. So I think this is kind of a starting point when you think about price evolution over the course of a year, certainly over the course of a month or a quarter. You never stay oversold for long. You never stay overbought for long. So either to reconcile this, we've got, call it 2 or 3 weeks of the market doing nothing. That fixes this. Or you have recoveries to start with, 20 or 30 cents, and that fixes this. But it will be fixed. It's kind of a matter of timing and what the catalyst for this fix will be. But the market today is oversold. We also think there's fundamental value in corn. And again, a lot of this is not rooted in some kind of secret bullish idea that we've got. Is just the market hit our downside targets very, very quickly. And so here we are. What do? 2 weeks ago, corn in Argentina was offered into the global market 35 cents per bushel below the U.S. market. And so we thought that that would really hinder or slow down U.S. export sales, physical corn export disappearance. And it did for a little bit. But the Argentine FOB market has been firming like it normally does in June. And so this is what you're seeing here kind of in both charts is the basis level that importers pay above or at times below the Chicago Board of Trade price if they want supplies from these regions. Today, after the firming of Argentine FOB premiums, Argentine corn, still the world's low-cost origin, but it's only 10 cents per bushel below the U.S. And even that relationship, we're still going to kind of dominate Mexican demand, West Africa, South Korea, Taiwan. We're still going to keep all of that business this summer. And I do think Argentine corn FOB premiums have, like they normally do, scored their annual lows, so that market probably gets firmer over the next 3 and 6 months. So corn is still competitive. Today, corn is still a lot cheaper than Black Sea origin corn. It is cheaper into Latin America than Brazilian origin corn. So I think that importers will find value in the U.S. market compared to Brazil or Ukraine. And even some places based on freight advantages like Mexico, we're lower priced than Argentina. So I think corn demand is going to be very, very strong at these levels. So the big issue, I think, is if we're to solve your offset demand growth in corn, it's got to be through weather. And this is interesting to us. I do think that cynically, the market's not going to react positively to wet forecasts. Wet and mild forecasts based on El Nino. That's what we've got for the next 10 days, and that's what's really happened since the early part of June. This is the forecast as it stands now. I think it is too wet in some areas, or something that we have heard from clients is, the normal course of events, low spots being flooded. But to me, it's just there's not going to be a lot of sunshine in certain places like Missouri, the Gulf states, the Southeast. That can be offset by July weather, but I think a lot of people would prefer warmer, drier conditions. But at the same time, you've got drought erosion pretty significantly. We have just in the last week more or less eliminated drought from eastern Iowa and Illinois, some pretty large spots of Wisconsin as well. You see the 7-day forecast on your right. I think drought may not get busted completely, but it's going to be eased quite a bit in Kansas and Nebraska. And so we're probably setting the stage for mostly adequate to surplus soil moisture as corn begins to pollinate. And corn's already started to pollinate earlier than normal in Tennessee and Kentucky based on seeding dates. And we think it's probably about June or July 10th when you start to see pollination occur, farther north into central Illinois, Missouri, parts of Iowa even. So I don't think there's going to be drought. Drought will not be an issue in the U.S. this summer. The Weather Service sees that as well. So we've got the latest, kind of hot off the presses. This was published a few hours ago. NOAA's updated 3-month drought outlook. And so you've got elimination most likely in Arkansas, Tennessee, Kentucky. And so you're really going to highlight the entirety of the principal corn soybean belt absence of drought. And I think this may be a little premature to call for, persistence or expansion in the central plain, just given the 7-day forecast. I think drought does move westward into Nebraska and Kansas. So weather's been very good. Crop ratings not historically elevated, but certainly correlated at this early date with trend yields. And I think they stay stable for the next couple of weeks. So I don't think it's going to be weather that catalyzes the upward movement in feed costs, at least for the next 60 days. It's after that, I think, that we kind of go back to focusing on this incredible corn demand, U.S. corn being competitive, ethanol margins being very, very good, soybean crush margins being very, very good. I do think that what's the thing that has jumped out to me this week over anything else, and I wouldn't expect this to drive Chicago corn prices just yet, given it's only June 18th, but I think the first concrete threat to northern hemisphere grain production, and I think could be a significant one, is emerging in Europe. And so again, I don't expect the market in the middle of June to begin the debate over whether it's too wet in the central U.S. or too cloudy, or is there nitrogen leaching, ponding, et cetera. But I do think that this is more concrete. We've got kind of a 2012-like blocking pattern being established in really the European continent, but especially Spain and France, and two of the larger European corn-producing states. This doesn't, every day that gets added to the forecast, it does not change. It stays very, very dry. Now we're looking into July 3rd, and we'll call this more or less zero rain for Europe outside of the Alps through this period. The acceleration of moisture loss, France, Spain, probably the United Kingdom as well, is going to be accelerated. It is going to be 101 degrees in Paris on Monday and Tuesday, and close to 100 degrees for the following 10 days. This is about 20 to 22 degrees above normal for Western Europe at this time of year. And so if you think about, does this change thereafter? And if it doesn't, I think you've got pretty sizable issues. And Europe as a whole has been a pretty large corn importer, one of the largest in the world when we think about the whole region, and increasingly has been buying U.S. origin corn. So again, this kind of goes to the other side of the balance sheet. Supplies in the U.S. look fine, weather is non-threatening, we'll call it, but I do think demand growth stays intact when we think about U.S. corn and U.S. soybeans as well. This kind of shows you the recent history of rainfall in France in June. You can see it's historically low, hasn't rained much so far in the month, and assuming the 2-week forecast, it will be capped at about 1 inch. Average is about 2.2 inches. And while we don't have a lot of confidence in forecasts beyond 2 weeks, especially 10 days generally, we do these are updated every day from a host of different forecasting models. And this is the latest GFS Ensemble 16 to 30 day forecast for Europe and North Africa. And at least as of today, there's not a lot of optimism that this changes. And I think and we've learned, and everyone knows this, it's heat is the bigger thief of yield over precipitation. And so if this is proven correct, then it's going to be incredibly hot in Europe between now and July 16th. And that will cover the beginning stages of corn pollination there. That balance sheet has already gotten very tight for a lot of reasons, and a lot of it was expected. They're planting more wheat, more oil seeds. They've had a lot of issues in corn kind of across the European continent, whether it's been heat and dryness, disease issues. Vomitoxin last year was a pretty significant issue. And so they don't find it as attractive. But over the last 3 and 4 years, just the European corn balance sheet's gotten increasingly tight. And we have seen that as that balance sheet has tightened, they have reached more for US corn. It's always been the case that Spain will take, a few cargoes of U.S. corn because they like their chicken meat yellow, and so they've kind of got exceptions from the European Union to import U.S. corn. Since 2023, as this balance sheet's tightened, though, we've added, Ireland and Portugal to that list, and so significantly so that I think that U.S. corn exports to Europe in the 25-26 year will be about 180 million bushels. That will be an all-time record between the two. And if this drought, develops as forecast by 30-day outlooks, I think that number could get to 220 million bushels in crop year 26-27. So you're just kind of adding to, not subtracting from potential corn demand when we look at the other side of harvest. And so that is what we want to position for. And soybeans, I think that they will, trade volatilely like they always do during the summer months, but there's just an incredible amount of value in soybeans. Since we have largely missed bulk Chinese demand this year, the crush plants have been able to go wild and filling their needs. And these are margins as they exist today in central Illinois. $4.70 per every bushel crushed. In May, it was $5.05 per every bushel crushed, just astronomically high, the highest they've ever been. The processor, though, if China does come back, and we do think China is coming back, by August, and they've bought this week, we think something like 500,000 metric tons of U.S. soybeans, and all of a sudden you've got competition for available soybean supplies that didn't exist a year ago. And if that competition does come back, then the crusher at least can pay $1 more for soybeans than they are paying currently. And so I do expect, seasonal trends to hold in soybeans like they've done in corn and wheat so far. So you tend to, have lows in soybeans sometime between August and the middle of September. Without a weather problem, I don't expect that market to add a ton of value. But thereafter, do we make these soybeans go away very, very fast? And I think what jumps out to me when we think about the soybean market, and so this is for soybean producers especially, is, kind of quietly, let us ignore everything that's happening between the U.S. and China with respect to trade deals, trade relations. U.S. soybeans are now, by a couple of dollars per ton, the cheapest origin to the importing space for August delivery and beyond. That is normally the case. So we have seen that when China, let's say in normal years, not like last year or 2018, but in normal years, they kind of slowly start to position themselves into the U.S. soybean market, start buying soybeans at some point between the middle of July and August. U.S. soybeans tend to compete with Brazilian soybeans in normal years in the month of August. And so that's still, 6 weeks away, but it's only 6 weeks away. So I'm showing you this because I think starting in August, soybeans are attractive to not only China, but to every importing country. And the sort of discount that U.S. soybeans have to South American origin only gets wider thereafter into December and January. So I think that soybean export demand somewhat normalizes. We kind of go back to what we talked about a couple of weeks ago, and that the U.S. and China have, we think, accomplished some kind of trade deal. It's still a puzzle to be sorted out, but they're going to buy 25 million tons of soybeans. And we don't know if it's prorated or not but they're also going to buy $17 billion worth of U.S. ag goods that kind of go above and beyond soybeans for the next 3 years, prorated in 2026. So does China kind of come to the market at some point? They eliminate their tariffs on U.S. ag goods, and that would be the kind of the canary in the coal mine to suggest China might be a buyer of corn, wheat, sorghum, and soybeans. And so thinking about physical price discovery, cash markets in the upper Midwest unlike a year ago, I think the risk is that the dairy operation is going to have to compete for bushels with China and the rest of the importing community, the ethanol plant, the soybean crusher. And so again, it's this the other side of summer looks, I think, very different from what it's looked like this week and last week, and maybe for the next couple of weeks. So here's kind of what we think about the markets as a whole. This is what there's a lot of things we always talk about. It's very complicated, but it really just comes down to this. You have to get your balance sheets correct, but the balance sheet will tell you if prices are fair and where they're going. So the red category, 26-27, this is US corn. I think what jumps out in any scenario, we can't forecast US corn exports below 3.5 billion bushels, new all-time record. And that is rooted in US-Chinese deal generally, and also this developing drought in Europe. And so the question is, we think about, spring highs. Can we yield our way out of this? So weather, like always, is going to dominate, but assuming the USDA's weather-adjusted trend yield, 183 bushels an acre, stocks kind of dropped to 1.7 billion bushels. That is not a raging bull market, but that does, we think, lift the season average cash price of corn to or above $5. And I think that does kind of foreshadow spring highs, something like 530 or even 550, if South American weather is not ideal. If we have a yield of 187, we'll be okay. I think the market just kind of mirrors what's happened in the last 2 years. That still gives you upside to 480 in the spring, harvest lows of about $4. In any scenario, though, it's kind of really hard, unlike last year, to build corn inventories. We're going to lose 4 or 5 million acres. If the perception of U.S. corn yield, and I don't think this will be the case for the next 2 or 3 weeks, but if it drops to 180 or 181, the balance sheet, perceived balance sheet at least, does get very tight very quickly. And so again, just kind of add this to the list of why we think there is value in corn at current prices. Soybeans similar, and this is just crush is going to be maximized. We in the USDA kind of calculate that at about 2.75 billion bushels. We'll use all of that because of biofuel policy. But something like corn, we can no longer, because of China coming back to the U.S. market and U.S. soybean prices being competitive for delivery in the autumn months, we can't really forecast exports below 1.7 billion bushels. So either, assuming the USDA's trend yield, we're left with 300 million bushels. That is an $11 to $12 market. Or if the perceived yield is 54 bushels an acre, we have more, but in no scenario do we have an abundance of soybeans. If for whatever reason we get into August, what U.S. weather is not ideal, and the perceived yield is 52, 51 and a half, I think you kind of get towards a rationing mode if that's the case. So there's a lot of risk, I think. Again, how that risk is being tilted given the sharp break we've had, it is changing. And kind of lastly, we think about weather globally for the next let's call it 9 or 12 months. So looking beyond the northern hemisphere cycle into next year's southern hemisphere cycle. And there's just a lot of uncertainty. I can't say it's going to be bad or it's going to be good, but something like super El Nino, or as it's properly categorized, very strong El Nino. Everyone agrees with this, whether it's computer forecast, climate science community, and finally now this week, the Australian Bureau of Meteorology, and they're kind of the best at doing this. So by October, this little sliver of the Pacific Ocean that determines whether we're in La Nina, El Nino, or nothing will be 3 degrees Celsius warmer than normal. That is the highest on records going back to 1950. And so we think, there are general correlations. El Nino tends to be, I think, good, or at least mild and wet in the U.S. during summer. It tends to be pretty wet in Argentina, far southern Brazil, very dry in Australia, very dry in Southeast Asia. So that's our starting point with this. But also, we don't have any analog years to compare to the strength of this incoming El Nino event. So I think we're going to see chaotic patterns, and it's kind of hard to say that because El Nino has been strong in the past, this is what this means for weather, because it's going to be stronger than it's ever been. Again, kind of as a base scenario, the things that we're concerned about is, India, the performance of the monsoon, which it's sputtered so far. It's not really meaningful yet, but if it sputters in the month of July, India's going to have a lot of crop problems, come spring 2027. They've got to refill reservoirs to irrigate wheat. ground nuts, soybeans. This year, that's something that we really want to watch closely starting July 1st. Cocoa in West Africa, that crop should be hit with drought if El Nino is present, and then kind of palm oil and wheat, barley, canola in Australia. Brazil is also kind of interesting. This is something that we can't really address until probably at soonest December or January of this winter. But when an El Nino doesn't mean Brazilian weather will be bad, but when Brazilian weather has been bad, an early exit of the monsoon, a winter corn crop failure, soybean yield loss, when that has happened, El Nino has been present. So at the very least, it does raise the risk of growing things and what is now the behemoth of Brazil in terms of exports of corn and soybeans. So just a lot of unknowable weather risks ahead of us. And that's something I think we want to watch. Again, all this is in the context of corn and soybean meal prices being where they are today. So what do you do in the feed sector? How do you manage risk? We would prefer to pass that risk off on to someone else on corrections in the market. So from very high level, we think dairy prices, milk prices are kind of stuck for the next several months. Feed prices may get weaker, but probably get stronger on the other side of summer. And so we want to make appropriate moves. As always, thank you. Questions, rebuttals, complaints, always welcome today, or you can email me at any time. We are here to help.
Awesome. Thank you so much, Ben. I actually do have a question that came through for you. You mentioned that we look to the USDA reports impacting markets. When do you expect the upcoming U.S. herd and specifically dairy replacements inventory report to come out? Do you have a prediction on how it might impact dairy markets?
Yeah, I think that it's going to show when it does come out in July, it's going to show the same thing. It's just there's been no improvement in replacement numbers for any livestock sector. And so you've seen the dairy space, well, we'll just milk cows for longer. I think that will be ongoing. So, but I do think what it will mean for the dairy space is, and this is a crazy thing to say, but when we think about dairy operation P&Ls, is milk a byproduct of beef? And I think that's generally going to be the case for another 12 months. I just don't think, screwworm was inevitable that it got here, but it's not going to help rebuild anything. And I guess in the background, it's the reason I think that this inventory report will not show improvement in replacement numbers will keep dairy milking herd elevated, but keep beef prices elevated as well. As I think the biggest determiner of how much beef we consume is sort of per capita incomes. And the U.S. economy seems fragile to us, but I don't think that per capita incomes will be meaningfully impacted for the next, even quarter. So, we're getting into peak seasonal beef demand. Thereafter, it kind of erodes all the time anyway. So I think we're going to use whatever beef is produced kind of at any price. So that's a long-winded way of saying I think the inventory report will show us that the beef cow market still on this bull trend, and that's going to help dairy operations if we're doing crosses.
Awesome. Thank you, Ben, for answering that question. And thank you to everyone who tuned in. We greatly appreciate you listening and your engagement with Ben here today. And we look forward to seeing you on the next episode of the Dairy Signal. Thank you and have a great rest of your day.